If you're looking to build a financial services franchise where you're going to have the most opportunity to influence and build loyalty, really is with that younger consumer segment, because that could be very much their first exposure to a financial services product.
Hi, and welcome to Credit Shift. My name is Paul Sweeney. I'm the Chief Strategy Officer at Webio. This podcast will be about how to embrace the digital future of credit and collections and all things AI and technology. Join us for the conversations that matter around credit and collections. My co-host is Dan Blagojevic, now Director of Decision Sciences and Machine Learning at the ever-growing Optima Partners. And our special guest today is Sean O'Toole, a very experienced executive in the financial services area. Sean has been a leader at such companies as American Express, First Data, Western Union, and Affirm, and was also entrepreneur in residence at Innovation and Global Accelerator Startup Bootcamp. Sean started, built, and sold his own company, RedWage, back in 2014, which was early into the underserved and unserved market spaces. Sean, I was thinking about the variety in your background and how it centers on payments and debit cards. And we have had an incredible amount of innovation around credit cards, debit cards, and corporate spending cards recently. And it seems that a lot of value here is in the control that they offer on spending or in the information that they help you gather. I was hoping that you might be able to give us a quick tour of what's happening in this space, but maybe a good place to start might be, I've always been fascinated by the psychological or behavioral aspects of these kind of products. Like, what makes for a debit card? What makes for a credit card? What's actually the psychological or behavioral aspects of these products? I was wondering maybe you could kick off and help us explore that topic.
Yeah. Hey, Paul. Thanks for having me on here. Happy to address that topic. Clearly, for a lot of my experience and perspective is in the US, so I'll kind of give it from the US perspective. I think that one of the things that's pretty unique about the US is the number of cards that are in an individual consumer's wallet, right? You could probably have anywhere in the region of 4 to 5 cards. And from a completely utilitarian point of view, one might say, well, maybe you just need 2 cards. You need a debit card that's attached to your bank account, and you need 1 credit card that has a rather large line of credit, hopefully, and that's all you need to use. However, we know that financial services, while it may be very utilitarian, it's actually also very much an emotional product. And what we see and what still holds true in the US is consumers really segment psychologically in their minds how they think about their cards. So for a lot of consumers, their debit card is what they use for everyday spend purchases, going to the grocery, the drugstore, paying for gas. And credit cards is maybe what they use for those products where there's like a higher value associated with it, maybe gives them the option to revolve. And I think over the last 10 years, we've really seen a growing use of rewards cards and particularly cashback cards. And as a result of that, I think we're also seeing a sort of real bifurcation in the market here in the US, where for consumers that are below a certain amount, who don't maybe have the FICO scores that allow them to get a lot of credit, they've become more and more debit dominant. And debit is really sort of taking over the role of cash. And we still use checks in the US, though a lot less over the last few years. Those consumers that are kind of below that income amount are a lot more debit dominant. But for consumers that are more affluent, there's really been a proliferation of cards. And what you see consumers doing is they're looking to really try to maximize what the benefits are associated with these cards. So I think, you will still find it if you ask people to open up their wallet and even show the number of credit cards that they have and ask them how they use those cards and in what situations they use them, they're going to tell you their reasoning and rationale. And so that points to this, psychological effect essentially as to how consumers think about their wallet. And it's all really quite unique.
Wow. Dan, you've got some background in this area. Do you have any comments on that?
Yeah, that's a very interesting US perspective, because if we kind of superpose that or juxtapose that, or against what's happening in the UK, it is quite a different dynamic and a different picture. In so much that in the UK, there is far less of a distinct difference between debit payment and credit payment. Part of that stems from the types of providers of those services, most notably the retailers who have a financial services arm, who quite actively encourage the use of credit cards as a way of everyday spending. So if we think about the two of the largest UK supermarkets, they have a very active credit card proposition, which is specifically targeted at everyday spending, so much so that the reward scheme itself is incentivizing people to use that as a way of spending on everyday services. The look and feel of payments between debit and credit in the UK is virtually indistinguishable. So if we did a straw poll on the streets of people who, what did you use to buy your groceries yesterday, a large proportion, not majority, but a large proportion wouldn't be able to remember whether it was a debit or a credit card. So there is much more of a blurring. We might talk later in this podcast around the fact that people aren't even using plastic anymore. They're using their watches and phones to tap. But that's a more recent phenomenon. But I would certainly say that in the UK, that distinction is far smaller than Sean, what you described. Whether that's better or worse, whether it's empowering people, giving them more choice, or whether it's getting them into more debt, I think that's for individuals to opine themselves.
Yeah, I think one of the major differences that we see between the US and the UK markets in that regard, and in many ways the US is really quite unique, is the number of financial institutions. So you have over 1,000 financial institutions in the US, and I don't have the data in front of me, but maybe the top 10 banks still maybe are just maybe around 50% of the market share, and consumers bank a lot at like large regionals or maybe even small, what we call community banks, credit unions. Most of those banks today are very much in the business of capturing a customer's basically what we call checking account, where there's a debit card associated with it. And just because of the size of the US market, being in the credit space is very much a scale game. And when you look at the US market compared to 30 years ago, the number of what we would call large credit card issuers is really less than 10 in the US, which is pretty remarkable given the number of financial institutions. But it just shows how difficult it is for a lot of smaller players, even large regional players who may have $50 billion assets on their books, to really compete in the space. So you've had this real distinction between most of the banks who are really looking to kind of capture the customer's DDA account, from a lending standpoint, focus on the consumer a lot more on products like mortgages, auto loans, etc. And the credit card space is very concentrated on a number of large players that are really playing an arms race around the product innovation that they can bring to market. So I would say that unlike in the UK, US consumers are probably pretty well aware of what form of payment they are using to pay, whether it's debit or credit. They can see that value being decremented from their bank account when it's debit. And in credit, they're probably quite conscious of what the line is. Clearly, in a lot of very affluent consumers, people really don't notice, and they're paying off their credit card statement every month. But really, in the US, I would say compared to the UK and other parts of Europe, individual consumers probably have a little bit more awareness around the forms of payment they're using and what the funding source is compared to what I've seen elsewhere.
I was interested, Sean, in what you thought about maybe psychology or emotion behind buy now, pay later offers, which have really grown significantly in the last 5 years. And do you think that, is there particular characteristics of why you think that's boomed so hard?
Yeah, I can only give you sort of like my perspective from what I've seen, particularly in the early days of Affirm. The sort of buy now, pay later concept, or the point of sale financing concept's been around for a long time. As Den pointed out, you can have stores that are offering their own credit product. And for folks that are, older than me, though I'm getting up there, they remember the day when you could go into the appliance store, and if you buy the refrigerator, you can finance it at the point of sale, right? That essentially is like a buy now, pay later product, credit type product. What we noticed is, and I think in particular, the sort of tectonic factor that really drove the buy now, pay later opportunity in the US was the Great Recession and the impact that it had on younger consumers in particular. And so one of the things we really learned in the early days of the firm is how much younger consumers really wanted to try to avoid credit. And this idea of like getting a credit card where, the repayment terms were stretched out over long periods of time. And it's a difference in generations. I think my generation in the US was very much looking at credit cards as essentially a form of like financing arbitrage. If I could move a balance from one credit card to another and get 0% for 12 months, that was a really great arbitrage, right? In terms of the cost of financing. But I think the younger generation at that time saw the devastating impact credit had when people lost their jobs in the Great Recession, and their aversion to credit is really quite high. I think what's also unique in the US environment compared to the rest of the world is how burdened young people are with student loan debt. So the whole sort of issue of credit weighs a lot more heavily on consumers. And in the early days of when there was experimentation with the firm with, merchants, there was much more of a focus on higher value items, such as electronics, jewelry, high-end clothing. What we learned was that younger consumers in particular were much more attracted to it. But what it really attracted to them was the ability to sort of basically set their payment terms to be relatively short. So when we give consumers the ability to choose between a 3-month, 6-month, or 9-month repayment term, they generally chose something between 3 and 6 months because it gave them control versus put it on a credit card and the idea of paying it off over time and just make the minimum balance. While it sounds like from an economic standpoint is probably maybe the best thing to do, depending upon the underlying rate, psychologically, it was just not attractive. The idea that they could pay off their debt within a short period of time gave that control. And we see that in the early days of buy now, pay later was very much a product that was attractive to younger consumers. It's become a lot more normalized now, going more mainstream. And I think that's a function of, quite frankly, that buy now, pay later is the penetration is just so substantial on almost every e-commerce website that it's the effect of marketing. It's there's a lot more factors going into what is causing its uptake. But in the early days, it was very much a case of it gave consumers the ability to control how long they were going to be in debt. And the idea that I can buy this high-end Gucci bag and pay it off in 6 months was, psychologically very attractive.
Well, I was going to just add on to that. I mean, in the UK, the dynamics of that has changed quite, or the drivers of that have changed quite significantly over the past 8 to 9 years. Sadly, in more recent times, over the past 2 years or so, the driver for buy now, pay later has been in large part the cost of living crisis. So it's not a by choice that some people, an increasing proportion of people, are turning to that. It's out of necessity. What we did observe, certainly here in the UK, maybe through kind of 2013 to 19. A real explosion of interest-free, very long duration interest-free credit cards. We were talking about 48 months interest-free credit cards. I mean, that's 4 years for free credit, and lenders were actively competing with each other who can offer the longest interest-free period on their lending products, and that in part stimulated the use of credit as opposed to debit within the UK. That did retrench quite significantly just as COVID came around. And actually, overall indebtedness did drop unsecured levels of indebtedness in the UK did drop over the COVID period. So people were actually paying down their unsecured lending and turning more to debit. We are seeing a reversal of that now, as I say, more because of the cost of living pressures that are coming in. But I think it's the buy now pay later phenomenon. It is very sticky. It's where we've seen it stick around during both the up cycles and the down cycles within the economy. So there might be very different drivers for it, but it seems to be a behavior that's in some way feels natural to the general population.
I think the consumers also, think differently around buy now, pay later and credit cards as obviously they're two very different payment instruments. But I think I don't think they look at them interchangeably, right? I mean, so in the US, if one applies for a credit card and let's say you get a $1,500 line of credit or a $2,000 line of credit. What younger folks in particular are concerned about is, okay, now I'll take that and, I'm going to lose my discipline about being able to manage that. Right. And rather than, using my debit card to pay for groceries or going out and restaurant, I'll use this credit card. And now all of a sudden I'm going to, before you know it, hit that $2,000 limit on a buy now pay later because, you're being choiceful about making that purchase and around, that I'm going to finance it and I'm going to make the decision over the time period and the term in which I'm going to pay for that. I think it appeals to consumers because it has a lot more of a control element. And when you look at what the average balances are for buy now pay later versus credit card, they're dramatically lower, obviously, versus credit cards. So from a pure sort of financial management standpoint, in terms of trying to avoid getting into trouble, using buy now pay later, where you're able to have these very short terms and requires you to have the discipline of paying it back, is very appealing to younger consumers, lower income consumers, than this sort of unsecured credit facility where, before you know it, you've hit the limit and now you gotta revert back to, using your debit card for everyday spend purposes.
You did say that word again, Sean, control, and having control over finances being a major kind of psychological motivator, which was surprising to me how strongly you rated that as an element of the psychological product. And it did remind me, I used to be obsessed by checkouts in shops, genuinely obsessed. And one of the best I ever experienced was in Limerick in Brown Thomas. And we were buying an expensive cream for Charlotte. She was getting some moisturizer or something. And as the woman the assistant was getting the bag ready and putting the cream in the bag, and she was stuffing it, she's saying, I'll put in little, free samples and stuff. And, we'll get this other one as well. And do you do this? And she was chatting away, and the bag was lovely and all secured up. And then we tapped it. You turn around and the credit card is being run and you're leaving the store and you have a lovely bag, you've paid. And that most difficult of situations is where you look at the actual amount of money you paid for that thing, was kind of avoided. That moment of transaction actually causes physical pain if you are paying in cash. So if you put on the dollars on the counter and you're paying it out, you go, oh my God, look at that money. Oh my God. And if you're doing it with a debit card, you also feel a degree of psychological and physical hit on it. But if you pay with a credit card, it's tomorrow's money. So it doesn't hit you the same way.
That's right. And we've seen this across the US. I mean, I wouldn't underestimate the impact that, we're still living with the consequences of the Great Recession, and we're still living with the fact that really until the COVID crisis hit, real wages in the US for most Americans really didn't go up very much and probably didn't keep pace with inflation. And we see it in the general mix of data from the data from the Fed Reserve around payment types. Debit usage has exploded. compared to credit. And while overall payments volume is going up, debit's share now is well over 50% and continues to grow. So I think, Paul, like you're saying, is, for consumers, money's tight. Control is important. And it's actually going to be quite interesting to see what happens here in the US, like around credit and credit trends, particularly for younger consumers, how it will impact buy now, pay later, because the moratorium on student loan repayments has now finished, and consumers are going to have to start paying back their student loans starting in September of this year. So we think that's actually going to have an impact on people's discretionary spend, because those like $500 to $800 payments were going towards purchases. Now have to be redirected to repayments of student loans. So it's going to be interesting to see how that shakes out in the US market.
The UK is, although it is a different dynamic here, it is trending in some part towards that, largely because it's interesting you mentioned the student loans. Unfortunately, the UK is trending very rapidly towards a position where practically most universities are charging larger fees, not in the way that they had done in the past. So there is definitely a lot more pressure on the younger generation in a similar way to what you're observing in the US. So yes, there's still, I think, in the UK, less of a distinction between those two types of payment mechanisms. I think that will change over time. Actually, one of the things that is certainly changing is the regulator is keeping a much stronger eye on how customers are treated, both after the onset of PSD2, but more recently the Consumer Duty Act, which replaced treating customers fairly. So there's much more of an onus on lenders being responsible in the way that they extend credit lines, which I think, as a consequence, is having that lenders will be less racy, let's say, in pushing credit where actually debit should be used as a primary mechanism.
Sean, just to tie up this section of our conversation, you've been an advisor to some very large companies and some very small companies. I've also worked across a number of technology companies and startups in particular, and I just don't see the psychology or behavioral aspects of these kind of decisions as front and center as maybe they should be. Have you noticed anything about that in your own practice?
Yeah, I mean, very, very much so. If you look at fintech in general and what's led the fintech revolution, right? It's been the technology side. And so many of these companies have been built by engineers. And they've been fantastic companies, right? You look at Stripe, obviously an example there with two Irish guys building it. You look at companies like Square, Adyen, etc. Even like all of the services that, even on the buy now pay later side, when it initially came out, most of the sort of founders around it and most of the early management are very much technology people and engineers, right? So many of the aspects clearly that I've been talking about around the psychological effect, you're more likely to think about those that coming out of like the marketing organizations, right? And I think that's been a sort of characteristic of fintech over the last sort of 10 years. How much of it has been driven by the technology side, and it's technology that has kind of like unlocked those components. And to a great degree, the marketing component of it has, maybe not kept up. And even when you look at fintech, like in the US, I would say that most of that innovation, again, is sort of like more on the back end. It's the plumbing, it's the infrastructure, right? There hasn't really been a lot of like many net new credit card issuers in the US, right? When you think about it, even though you have these massive pools of capital that are beyond the banking sector, where you've had like great examples are people like On Deck Capital, right? And Credit Karma in terms of some of the things that they've done. But most of the innovation has really been focused more on the sort of like infrastructure, technology, back end side of the equation, and a lot less on the front end side. And I think actually, we still have more room to run on that. I mean, when you look at a lot of what's happening around embedded finance as a key trend, I mean, what essentially, that is sort of the further and further integration of software and payments to make the checkout process much easier for consumers to, give them options to either finance that transaction at that point in time, et cetera. Again, that's a lot more driven by the technology side. And I think, what we've seen is the marketing side of the equation needs to catch up with that. Like, at the end of the day, if you're going to build a great consumer brand, you need a lot of marketing DNA in your company. Which is maybe why as well, a lot of the, traction on the B2B side has been a lot deeper than on the B2C side. Consumer's hard, right? Consumer's hard.
Yeah, essentially you hit the nail on the head. And actually in the UK as well, what's happening is that basically the fintech disruptors, they've built banking around technology, not technology around banking. So that's a fundamentally different approach to.
Yeah, and I think when you see that there is that challenge, I mean, I think the plight of neobanks in the US is a really great example. Like, I just, to make a broad statement, which, now that I'm American influenced, maybe just sort of very much from this side of the Atlantic, right? Is that like, neobanks the bar was really low in the UK in terms of the quality of banking. So as neobanks were able to come out and bring out better quality services, et cetera, they were successful. And there are only a few banks in the UK. To take that formula and apply it in the US has proven to be a failure. One is because, again, it's the incumbent banks caught up pretty fast. My mobile app with JP Morgan Chase is actually really quite good, right? And so Bank of America, Wells Fargo, looking at all the companies out there like FIS and Fiserv, they invested heavily in the technology and the infrastructure. And it's now at this stage, it's caught up. So the question is, what the neobanks have been really struggling with in the US is like, essentially, what is a differentiated consumer value proposition? What's 10x about what they do versus banks in the US are doing? And given that there are, so many very large banks with deep pockets that can make those investments, essentially it's a much tougher competitive environment. So I think a lot of the early stage neobanks kind of got to market because it was much harder for the incumbents to move, and they could use technology and they could use UX to gain a competitive advantage at that point in time. But, what sustains that? Like once everyone else sort of caught up, really, at the end of the day, the challenge is they're really suffering from a differentiated consumer value proposition. And again, that's where the marketing kicks in. So, once sort of technology catches up with, and gets adopted in all of these companies, including these big incumbents, it really gets back to, how well you know your customer, how well you're solving your customer's problem. And that probably is less about technology and more about insights around customer needs and how you can better solve their problem than how they're solving it today.
Yeah, I love that, Sean. But insights are like just the best. Like when you get them, they're gold. They're just amazing. And the deeper and more scalable they are, the better. I love that part of the conversation, and I think this is a great segue into the next part of the conversation. I think one of the things that we were moving towards, Dan, in our last conversation was the idea of the credit unserved and the people who weren't really captured by any existing infrastructure or institution. And I was just wondering, Sean, if you could maybe walk us through a little bit of your experience with Red Wage and what drew you to the problem, because the problem is often the most interesting thing. And maybe just walk us through your early experiences of that, and maybe we'll take the conversation from there.
Yeah, sure, absolutely. So I think in the days in the late noughties when I started Red Wage, I had worked at Western Union for many years, serving consumers that were primarily immigrants from other countries looking to send money back home. But as you can imagine, they needed to conduct their business in the U.S. and be able to, do financial transactions. And they were very much attracted to what we call in the U.S. the alternate financial services environment, the check cashers of the world, because a lot of people got paid checks and would take their check and go in and cash it and walk out with cash after paying a hefty fee. So it was, and still is, but at that time was even more expensive to be poor. And be able to access financial services at that time. So we, at Western Union, we launched out a prepaid card, which was is technically a bank account where consumers could load money onto their card and they'd get a piece of plastic with either Visa or MasterCard logo on it and be able to spend just like regular folks. And, the at that stage, and most of these consumers really didn't have access to these types of accounts, and so adoption of those programs were great. But also, you still had issues of consumers being quite suspicious of bank and the security of cash, and not everywhere took credit cards, right? Even in the US back in those days, So when I formed Red Wage, it was the idea of a concept called a payroll card, where you could go to employers and who were still paying certain segments of their employees by check, and allow them to deposit the funds instead on a card, so they could get a payment instrument. Help them avoid check cashing fees, but the value prop to the employer was it would also save money, do right for their employees, etc. One of the things we learned back in those days is I think employers cared a lot less about their employees than what we had hoped. We had a value proposition where we would ask the employer to pay $1 a month per employee, so we could avoid feeing a lot of the card holders, which was how the economic models of these things would normally work. And I think we got a lot of we actually don't care, that's their problem type of response, right? Given the growth of payroll cards in the days since, thankfully it does seem like that sentiment has shifted to a degree. I think when you look at the US today, given that, when I started Red Wage, those are very much the early days of prepaid. I listened to an interview recently done by Matt Harris of Bain Capital Ventures, who ran his own VC fund back in those times. And he was one of the only fintech investors. I mean, it's so much so, I think he felt like maybe he was doing something wrong because nobody else was in it. How that world has changed, right? And there've been a couple of tipping points to that, right? The iPhone, I think, was a massive tipping point in that. The growth of digital wallets, the fact that where the US needed to actually make the investment in chip technology, basically required the entire point of sale infrastructure of the country to be replaced and upgraded over a period of 5 years. And that plus technology like the Stripes of the world, et cetera, really allowed the explosion of new products and services around prepaid that has happened. So what we've seen in the US is the percentage of folks who really are without a bank account is much, much lower than what it was before. If folks don't have a bank account today, it's for reasons where, they don't want a bank account for reasons other than they can actually get one. But it still is, from an economic model, it still is expensive to be poor, right? A lot of the economic models of those products require feeing the consumer. Just like we were talking about credit cards early on, the dirty secret of credit cards is all the rewards are basically, it's more affluent people that are able to take advantage of it, and it's funded by lower income folks, right? Essentially, right? And so, when you look at like the market, it's in a relatively short period of time, it's changed almost beyond recognition. And again, technology is very much a large part of that. The digital wallets are also a large part of that. Competition that has come in general. But so the days from when we did Red Wage as one is sort of like the early prepaid providers to, your ability to launch a prepaid card today, such as either Uber or Airbnb or Instacart, where everyone has a prepaid card, is really, we're talking almost different eras.
Yeah, I mean, in the UK, there's I think there's circa 5 million adults who are, let's say, invisible to the credit reference agencies, i.e., they don't have a financial footprint, and that number is actually quite stubborn. It's plateaued over the past, let's say, 10, 15 years. It was on a steep decline, and it's reached a plateau. So there's clearly a certain dynamic that's stopping people getting access to banking products. I don't necessarily agree with, who was it, Bob Hope, who said a bank is a place that will give you money if you can prove that you don't need it. I think that's pushing it a little bit to the extreme, because that's largely around lending money. But access to basic banking facilities is still, there are still barriers in the UK to that. Now, some of those are cultural, but some people are afraid of stepping into that market and actually opening up themselves to potential ability to get into debt. But there's certainly a push towards offering what I call some credit builder products that will allow people to build that credit reference agency visibility, that will then open up that virtuous circle of being able to access more affordable products, both debit and credit products. It's early days, but what we're certainly seeing is that some of the payment service providers are starting to eke into that space. So the likes of Apple Pay, Google Pay, I think Tesco and Sainsbury's have now their own equivalents. M&S Money have their own payments service provision. By that I don't necessarily mean a current account or a credit card, but an actual payment mechanism that links into another product. I think that's what's going to change the market in the UK. As I say, it's early days, but yeah, it's quite interesting that number of invisible individuals is quite sticky.
Yeah, I would say in the US is that, when you peel back the onion as to what are the segments of consumers that are, essentially unbanked, there's certainly going to be a segment of consumers that, don't want to be banked or are quite suspicious of banks, right? And so for them, cash is the sort of best control mechanism that they have. And, even though we see the usage of cash as a tender type like fall dramatically in the US, I think there's always going to be a stubborn segment out there for whom cash is king. And then, of course, you're always going to have like new consumers, coming into the market. I mean, given the size of the US, I don't know what the number is, but there's probably somewhere in the region of like 2 to 3 million new 18-year-olds, right, every year, right? That's a lot of folks who are now adults. They may not act like adults, but they are legally adults, right? And so now they can sign up for financial services products in and of themselves. So what I think what we'll see is, and I agree with your point, is that I think you're going to see over the next few years a lot of the sort of like very non-traditional or entities that maybe have not been as active in financial services and payments get a lot more active in those markets where they have access to large data sets. So it's very interesting. You see with Apple and their sort of buy now, pay later, they got their training wheels by having Goldman Sachs do the underwriting for their Apple card, and the training wheels came off on that, but they learned on it. So guess what? Apple today is underwriting their buy now, pay later. So they've learned, right? They learned from someone else, and now they're applying all that logic. We're going to see Amazon, right? No one knows probably more about your purchase history than Amazon, right? And you're going to see Amazon, I think, getting much, much more into looking to apply these types of solutions in the marketplace. And, part of the trick was, and in the early days back in AmEx when I was there, one of the things that really built the AmEx franchise was AmEx was one of the few people who would actually give a charge card to, a young person coming out of college. And, the fact that you were catching that person at that point in time where they were the only person who would give you access to credit, probably if you look at those cohorts, the amount of people who've stuck with Amex over the years, that's probably a really, really high retention rate.
It's an interesting statistic in the UK as well that people who open a student account generally stay banking with that same provider for the entirety of their life.
Absolutely. So I think, if you're looking to build a financial services franchise, today, and granted, there's competition in every single segment, but where you're gonna have the most opportunity to influence and build loyalty really is with that younger consumer segment, because that can be very much their first exposure to a financial services product.
It just reminded me there of recent, like Bank of Ireland had a lot of problems trying to get their infrastructure in place and be competitive, and therefore you had that ineffectual incumbent. Revolut card came in. I think over 1 million people now have a Revolut card in Ireland. It's a big deal. And then Revolut have now a card where you can give a card to your kid. And I'm just thinking, they're Revolut customers now, your kids. Like, they might get their first student loans, they might get their holiday loan from Revolut, and now they're going to start a relationship with Revolut. And that's really an interesting precursor for what you're saying about the future. I was just thinking as well, Sean, about the ability to see and not see opportunity. I think it was Dan taking the point that many people are credit invisible because they don't have a credit score and they can't thus get started into this system. It's an example where the data is blind and therefore management is kind of blind to it. And Sean, you said something recently a couple of times about data sometimes hides insight. It doesn't reveal. I was wondering if maybe that's something you could just open up a little bit for us on.
I think it's a challenge in all organizations where, like, it's great to be data driven, and I'm most certainly a data geek as much as anyone, and I love playing around with spreadsheets, and I'm still trying to figure out how to write certain macros. So data is wonderful in that, it helps you kind of reveal certain trends, et cetera, but it doesn't really yield the insights that you're looking for. At least I believe, versus being able to go out and talk to the customer, right? So, part of the challenges with data is, particularly if you use averages, and looking at profiles, you may actually end up creating a profile of a customer that actually doesn't exist because that's just what the data says. So I think the trick is, how do you first start to, rather than putting data is the place where you go fishing, to start instead, going out, talk to your customers, try to understand where they are in their journey, what problems they're trying to solve, and try to use data in terms of being able to, understand their behaviors in those situations. Gives you a lot more context. And I think this is part of the challenge around a lot of really big companies. And it's at times where you're building out a very sort of, deep and sophisticated sort of like, data science team. You can get very much lost in all the details of what those numbers are saying to you, but you may lose sight to what's actually happening outside the walls. Right. So, as a taking the scientific method, it's about formulating hypotheses, understand what your assumptions are, going out and validating your assumptions. But, really good data people I've worked with in the past have really learned how to, go back and forth between, it's a little bit being ambidextrous with your brain, being able to go out and actually talk to consumers and then go look at the consumers again and try to validate those assumptions. It's big companies are very much guilty of it, but I think it's one of the challenges as with smaller companies as well as they scale. You have more people around. You're looking at a lot more of the data. You're spending a lot more of your time inside the building than actually outside the building talking to your customers. It's part of the role, I think, as a CEO of a scaling up company is how do you make sure that you don't lose that, the customer North Star and the customer voice and really bring it inside the company, and you're not spending way too much time talking to each other.
So, I mean, for what it's worth, I think one of the key challenges with data is the missingness at non-random, and the bias, the inherent bias that exists in real world data, because data is generated by actual customer behavior, but it's also generated by decisions which are made off the back of that data in the first place. So, data coverage is a big challenge for organizations, and the ability to generalize decisions based on that partial coverage is really where the risks are. The analogy I always give is that if I can lose my keys on the street, I'm not going to be looking for my keys where there's a lamppost just because I can see underneath there. Right? There's a whole street which is not covered by light where I could have lost the keys. So that analogy carries across in terms of data which is used to make informed or not informed decisions, because what we find is that the segments of the population that are data rich are precisely the ones that we don't necessarily need that data richness to be rich on, which goes back into the underserved population conversation, which is where the vicious circle comes in. So it's the ability to not analyze data per se, but to have generalizable insight from the data that we have. Now, and then also be very well informed on where those algorithms that we base on data do not generalize. So be very, very conscious and cognizant and informed of what's the limitation of data-driven decisioning, and actually then inform, okay, how do we see that data space if we do want to use that data going forward? So is that through champion-challenger campaigns? Is it through control cell methodology? Sean, to your point, do we go and speak to customers to do some market research to generate that data? But that's really where some of the strategic thinking needs to happen.
Sticky end of the wicket. I'm just thinking of this data going into a large language model and then how it becomes further distorted in that process. Definite concern.
Yeah, absolutely. I mean, data has a habit of creating its own reversion to a mean, right? But it's a mean that may not actually be the mean that's out there, right, in the world. Now, granted, if you have a very, very clear understanding of the customer segment you're serving, and you're able to get very deep, and that's your starting point, and you're staying in that segment, the data you've gathered, you've probably got the deepest insights on that customer segment, of anyone out there. The challenge is when you're starting to take that and try to basically, infer that data on how other people behave. The example I give is, companies that are you're sitting around the management table, and in a very New York type of way, you're basically having a whole bunch of wealthy New Yorkers sort of trying to understand and say how people in Ohio behave, right? This is what happens, right? The data tells you and gives you a set of confidence around how you think you should behave that is just disconnected to reality, right? And so that is the danger.
Well, if anything, LLMs are abstraction machines, so we've got to be careful of that. Sean, it would strike me that that point about living in the data and living in the real world is a kind of predictor of whether someone is going to be successful or not, or a program is going to be successful or not. I think that'd be, from your nodding, I'm going to say I think that's fair. Again, you've operated at the highest levels of international finance and the startup level. Are there any other kind of predictors of whether a program is going to be successful or an executive is going to scale?
Yeah, I mean, you bring up a really great point, Paul, because sometimes whether the program's going to be successful or scale, and whether the executive is successful, can actually be two very different things, right? So, if we talk about things from a product standpoint, at a like, what is it that the tools that executives can use to predict whether a project is going to be successful or not, or a product or service is going to be successful or not. The key thing I would sort of give advice to folks is really kind of do an awful lot of testing with consumers. A lot of lean startup tools and methodologies are really, really great skill sets to learn for executives that you really don't, enterprise executives don't really get the chance to learn that. But when you're living in the startup world, you kind of learn it by default. Get out there and talk to your customers, right? And run lots of experiments and to see whether, customers are actually going to do versus what they say they do, right? So
oh yeah,
that's the big thing I would say to folks, that, if you want to learn, if you want to be successful, you want that project to be successful, it's really go out and experiment, go talk to your customers, hear what they have to say, test a lot of concepts, right? Because customers are going to tell you whether what you're giving them is a vitamin or actually a painkiller, right? So that's the number one thing I would say. I think part of the challenge that enterprises have is when it comes to executives and executives being successful is, are they providing the right incentives, right? I'll give you an example from the payments world. There have been times I've seen that, product managers or business unit managers got rewarded for delivering really great profitability results, right? And how they did that was maybe by raising the credit card interest rate by 20 basis points. Right? Like, okay, any clown can raise the price, and if consumers are still sticking around, it's going to generate a lot of money. But you can imagine what sort of negative effect that has on the consumer value proposition over time, right? And so I think the one thing for enterprises really struggle with is, what are the right metrics, right? They should be using to measure executives, and how do you know that your card programs are healthy or not, right? And so the rewarding the person who is going to take the shortcut of raising, interest rates a few basis points, and the next guy does that, and the next guy does that, is not really investing in making sure you're developing really compelling consumer value propositions. And so, that can be hard, right? That can seem like easy money. And this is part of what's happened, with some of the credit card issuers in the US over the years, is they essentially got lazy, right? And so this is always why we want disruptors coming in, new entrants into the market, because companies will act, whether they're big or small, whether they've been around 100 years or around 20 years, they will act in monopolistic fashion, unless there is actually really a competitive environment out there.
That notion of what metrics to track, that's actually something that we talk very much to clients here as well. People talk in the UK, I don't know if it's a term in the US as well, customer value. Intrinsically, what people mean here is value of a customer, not a value to the customer. Now, there should be a sweet spot where it's a win-win situation. I don't think it often is. I think quite the opposite. Those metrics which define customer value, quote unquote, are very much to the benefit of the business, but there's a big question mark as to whether they're to the benefit of the customer. So really, customer value should be thought in, and the metrics that measure that should be thought of that sweet spot that actually delivers both. And in the UK, I don't think we're there yet. I think there's still a way to go.
I think in the US it's probably less of an issue, because what we've seen is the biggest indicator of whether you're serving your customers or not is whether they're purchasing from you or purchasing from someone else, right? So having large numbers of competitors in any market environment is probably the best guarantee of for companies to deliver customer value that I've seen.
I think, Sean, you just have to remind me of this week Visa MasterCard news is that between them, their fees will now amount to $94 billion. This is up from 2012, where it was $33 billion. So a nearly tripling of fees in that time. And, their, I guess, case for this is that they provide services in line the way I think about them, which is, identity services, fraud services. You're using them online. They've got a lot of kind of invisible services that you don't see as an end user that they've invested in. But I can't. I read that line and Jeff Bezos's voice entered my brain saying, "Your margin's my opportunity," and I'm thinking, "Oh my God, that is such an opportunity." And it's in the same week when Visa announced a new stablecoin infrastructure play that they're going to make a lot of that infrastructure in the background kind of disappear with the new blockchain type solution. And I'm just thinking about what happens to the innovation here, where you've got the potential. Like if you said to somebody, "Hey, I've got $100 billion in fees for a service here that's largely invisible to people and is delivered online. And I've got blockchain, I've got generative AI, I've got fintech stacks, I've got banking as a service platforms." I'd be wondering what network is going to disrupt this network. And you've already said the two names that are top of my list, which is Apple and Amazon, right? And everyone thinks the monopoly is unassailable till it falls. So Nokia was unassailable until iPhone came out, and then everyone went, "Oh, okay, that's a pretty cool phone." The second iPhone came out, Nokia was like really sliding. Third iPhone came out, Nokia was in real trouble, right? Just 3 iterations of one iPhone. And I'm just kind of thinking, it's a provocation. I'm not asking for an answer here, but my provocation is, with an opportunity that size, like a disruption has to come. There's just too much money on the table.
Yeah, listen, like Visa and MasterCard have done a remarkable job of essentially further embedding they're essentially like monopoly in the US. And, the shift to sort of like online and mobile payments has given them an opportunity to, because some things are certainly very useful. Tokenization is very important, right? It helps with fraud and risk management. But many of the other services, I think some merchants would say, are probably dressed up to be, more sort of plumbing, and now you're charging fees for that. When you think about the opportunity to disrupt Visa and MasterCard, I think a lot of the conversation a lot of time is focused on, developing additional plumbing and what the opportunity is to do that. And there are additional networks out there. In the US, over 10 years ago, a law came out, the Durbin Amendment, that required the addition of another network onto all debit cards. And there are debit card networks out there. I think what you've seen is that, pricing, the debit card network pricing is maybe not as competitive as it could be to take share, and probably because many of the ownership of those networks are also quite tight with Visa and MasterCard from a business standpoint. So I think actually, technically, it's possible to build an alternative plumbing. It gets back to, though, at the end of the day, you've got to get those payment types into the hands of consumers.
Yeah.
And I think, to your point, this is where the opportunity is really for the Apples and the Amazons of the world. The question is whether they're going to come to the market, which it doesn't appear at this point, whether they're going to come to the market at a price point to merchants that's substantially less than what Visa MasterCard charges. Currently, their interchange, or what they're charged merchants, is the same, if not slightly more than what Visa and MasterCard charge. So the game, when I look at fintech over the last 10 years compared to the days when I was at American Express, we would say payments had to work for not only the network, it had to work for the issuer, the customer, and it had to work for the merchant. Over the last 10 years, really the merchant has been essentially been scratched from that equation. And it's the merchant that has been funding through interchange a lot of the innovation that's happened in the US. And so merchants have over the years kind of given up fighting this through the legal battles that they've gone through, and may even been precluded from suing in the future. And so now merchants are very much in the case of accepting all forms of payment because they don't want the customer to walk out the door. But the cost of those payments are quite high, right? So I think in the US, we're in this sort of like cycle of interchange will stay high, and interchange is a very large driver of the economic models for fintechs in the US. So it's not clear to me that there are going to be companies who will come out and they'll, with their innovation, that's dramatically going to look to cut interchange, because they're probably going to depend on interchange for a very large part of their revenue source.
Yeah, I mean, the whole point here is that this is a transnational network far more than the banking system itself. So I generally can't see, short of the whole central clearing system getting disrupted and by some form of peer-to-peer payment mechanism, I can't see that there will be a new disruptor in the space, unless, Sean, as you say, the likes of Amazon or Apple decide actively that they want to get into the space, which, as you say, I'm not seeing. So.
Yeah, no, absolutely. I mean, we have some in the US. There are some pretty substantial peer-to-peer applications. Venmo and Cash App are two. Both have come out and issued plastic cards on the Visa MasterCard network, so they earn interchange when the spend is that way.
Exactly.
Or if you do pay using the QR codes, their actual rates are the same, if not higher, than what Visa MasterCard charges for essentially a debit transaction. So, we've not seen that, right? We've not seen that, right? And at the end of the day, I think also, US is such a large competitive market. The cost of customer acquisition is very high. Cost of retaining customers is high. I don't think a lot of the economic models out there could afford to, say, let me take a big haircut to interchange, right? Unless they're able to, find other ways to acquire customers cheaper. I think in the US, we're stuck with it for quite a while.
All right, folks, listen, we're banging up on the hour here. I think the hour is our culturally defined limit for how long anyone should be talking at somebody else, well-trained in our legacy systems of school. So, Sean, listen, pleasure speaking with you today. Thanks so much for joining us. And Dan, thanks again for being our co-host. If there's any questions, I'm sure we're going to follow up with one another and try and raise a couple of these topics a little further. So thanks everyone for joining us again today for our series of interviews, Credit Shift, with leading speakers and practitioners in the world of credit. Thanks for joining us for that amazing conversation. And remember to subscribe so you don't miss any of these future leaders talking about the changes in the credit and collections business. We'll also be pushing out weekly updates so that you get all the news as it happens in the industry. And also, why not drop into webio.com, see what we're doing these days.